Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, the U.S. strikes a trade deal with Japan. We'll bring you the latest trade updates throughout the show. Plus, for today's Investor Playbook, we'll dig into the winners and losers in the defense space. And as President Trump plans to lay out his AI vision, we'll break down the hurdles that could stand in his way. All that and more coming up on Market Catalysts. Let's get a check of the markets. First of all, here this morning, we're now seeing a mixed picture for the three major averages. Now, remember the setup here. We have this morning a reaction to an announcement of a trade deal with Japan, even as Bloomberg is reporting that the EU is standing ready with a package of retaliatory tariffs if they don't come to an agreement. We've got earnings to contend with, and then investors also looking ahead to earnings after the close from Tesla and Alphabet. So all of that said, we're seeing some weakness within the technology sector today, as evidenced by the weakness in the NASDAQ on a relative basis. The S&P 500 poised for another record close if it gains at all today. And then the Dow is leading gains up by about 1/3%. Let's also look at the bond market here this morning. We have been seeing yields at sort of settling at a lower level here today, even with a 4 basis point increase, the 10-year still at 4.38%. Well, the Dow and S&P 500 rising this morning, perhaps that trade optimism contributing there. President Trump's announcement of a trade deal with Japan lifting hopes for further agreements, but there will be 15% reciprocal tariffs on imports from Japan, and the company will invest, it says, or Trump says that is, $550 billion in the U.S., with, as President Trump said, 90% of the profits going to the U.S., whatever that means. The S&P 500 notching its 11th closing record of 2025 in the last session. Here with more, Brian Levit, Invesco Global Markets Strategist. So I think, Brian, and it's good to see you, first of all, I think we're trying to sort of suss out, are stocks sort of up because of Japan? Is that, or, you know, what's really going on here, and how heavily are folks weighting that when we're still looking at a 15% tariff on imported goods? What do you think?
Yeah, the market's been going up really since April 9th when we paused the tariffs. And so the market is set up for the expectation of better news with regards to trade policy, a continuation of resilience in the U.S. economy, and inflation that remains relatively contained. So that is the setup for markets. Today's news provides a little bit of the clarity that the markets have wanted. It's a less optimal outcome. A 15% tariff, to your point, is quite high, but it's incrementally better than what the markets had initially feared. So directionally, I suppose, in the right place, but a less optimal outcome than we probably otherwise would have seen.
Let's talk about the setup for earnings, right? Because now we definitely see, yes, we have stocks overall that have been drifting higher, but we also have a lot of individual stock reactions because of earnings here. We've got Mag 7 that are starting after the close, whatever Mag 7 even means anymore. But what kind of themes are you going to be watching for in big tech, and do you expect some of the outperformance to continue?
I do, and I mean, the reality is the expectations coming into this earnings environment were actually quite modest, and so companies are doing a decent job of beating expectations. It's not only tech. You're seeing it in the financial sector. You're seeing it in the industrial sector, which is benefiting from the AI build. You know, with regards to the Mag 7, it's not a homogenous group. So there's certain names that continue to benefit from the AI build out and are likely to benefit from that structural theme over a long time, versus other companies that may be related to autos or hardware that may have more idiosyncratic challenges. So I wouldn't paint them with one homogeneous brush, but the reality is those are the types of businesses that are likely to continue to grow earnings far beyond that of what you're seeing for the broad market. And if you're in a pretty modest growth environment, then investors are likely to continue to look to those higher quality businesses that can grow earnings.
Do you think we'll continue to be in that modest growth environment?
Yeah, well, we're going to need a policy response to come out of it. And so, we've been in an environment where leading indicators are certainly not collapsing, but not pointing to anything amazing, really pointing to below trend, sort of weaker growth. And so when you're in that type of environment, you usually get a policy response. It typically comes from the Federal Reserve. So a lot of focus on what the Fed's going to do. The challenge is we still need to see the effects of tariffs. So I do think the Fed will ultimately lower rates, but it could take a little bit of time. The other policy side, of course, being on the trade front. So can we get incrementally better outcomes there, create greater clarity in the economy, lead to a reacceleration of economic activity? I think we'll get there. This is not an economy that appears to be heading into a recession or anything like that. So we're going to need a better policy response in order to reaccelerate activity.
Brian, the bond market's been pretty quiet, right? I was just looking at rates that are below 4.4% here. Given the dynamics you're talking about with inflation, with what the Fed might do, what do you expect Treasuries to do going forward?
Yeah, the 10-year rate seems to be pretty reasonably priced. I mean, I think of a 10-year Treasury rate along the lines of what should your 10-year expectation be for nominal growth. A couple of percent inflation, a couple of percent real activity seems reasonable. I mean, the challenge you have in the bond market, I don't think rates are going to move all that much, but what investors need to be grappling with is, inflation expectations picking up a little bit, certainly not to a particularly troublesome level, but picking up while TIPS yields going down. So what that's basically telling you is real GDP down, inflation expectations up. That's not a entirely great mix. But I do think that the Fed will see through the higher inflation expectations, so long as they stay relatively contained, and will lower rates. So I think the 10-year is pretty reasonably valued here. If the economy does moderate, I would expect yields to either stay where they are or come down a bit from here. I don't think we're breaking higher.
Gotcha. And you don't expect any more sort of bond vigilante deficit, sort of tantrums in the bond market?
I thought that was overstated. I was trying to push back a little bit against that narrative. I understand the 30-year moved above 5, and that had some people concerned. The reality is that wasn't a historically ridiculous premium between the 10 and the 30-year. It was more of a normalization. So if the 10-year is at 440 or 438 in a 4.5% nominal growth country, to me, that's not bond vigilante. That is a very appropriately priced 10-year. You put some term premium out to 30 years at 490 or what have you. That seems very reasonable to me. That does not suggest to me a flight from U.S. Treasuries by any stretch.
And finally, Brian, I want to ask you about something you think the market is not paying enough attention to, and that's mid caps, right? We talk a lot about large caps. For a while, everybody was talking about small caps. Where do mid caps fall into the equation?
Yeah, mid-caps are almost always forgotten about. People think that they go large and small, they have it covered. The mid-cap index looks attractively priced, and what we like about it is you're seeing more businesses come to the IPO market as mid-caps, or at least our expectation will be for that going forward. And if we do get more of a wave of mergers and acquisitions, the mid-cap category stands to benefit. There's also a lot of companies in that space that are providing support in the build out of the AI theme. So it's a little bit unloved right now. Over the next couple of years, we think, given the valuations and structural themes, mid-cap should benefit from that.
Brian, good to see you. Thank you.
Good to see you. Thank you.
We're looking at some new data just out this morning. It's on existing home sales falling more than expected in June. Here with the numbers and some perspective, we got senior housing reporter Claire Boston. So I'm seeing a decline of 2.7% in June, Claire, which indeed is worse than estimated.
Yeah, Julie. So we were expecting a seasonally adjusted annual rate of about 4 million homes sold this year. And as of June, we're at 3.93. So a good bit worse than expected. That being said, not super unexpected, just given what we know about the market. Affordability is super constrained right now, and mortgage rates are still high. And, I think what we're seeing is that this spring home buying season was pretty much a bust. So existing home sales, they cover a period where maybe a month or two earlier things went under contract. So that's like April and May. This is really prime time. We're seeing disappointing numbers. And, I'm not sure that a lot is going to change in this market until mortgage rates and potentially prices go lower.
It's also interesting. I know that undersupply has been such a big issue, both in the existing and in the new home sales market. And I can't help noticing here, total housing inventory actually fell compared with May. It is up year over year, but I know that that's something that is sort of a persistent issue here.
Right. We are still undersupplied in this country with housing. And I think when you're seeing that inventory fall, what's happening here is that recognition from sellers that this is not a great spring to sell. We are seeing delistings on the rise, just data saying that people are taking homes off the market. That just makes things even harder for buyers in this environment. Especially we talk a lot about the Northeast and the Midwest as being parts of the country where inventory is really, really constrained. And, again, really no relief there right now.
And then there are prices, right? Because affordability is yet another piece of this whole thing. The median existing home price, $435,300, which is up 2% year over year. And they say a record high for June. So no relief there either.
Absolutely not. So yeah, that 435,000 figure is actually an all-time record high. And, again, I think that's why people are on the sidelines. You have record high prices, you have not record high mortgage rates, but, higher than we've seen, historically for a long time. And as a result, those buyers are really constrained. Maybe they want to get into this market, but they really can't. And, we are building homes, but not everywhere. There are places that, you really don't have space to build. And there are places where we're oversupplied with housing. And so, what we're seeing here is just the fact that, nationally, we still need more homes to be built. And, until we have, that kind of supply and demand balance, we're going to see home prices keep rising, probably.
Claire, thank you so much for your perspective.
Thank you.
Appreciate it. Coming up, we're going to take a deep dive into aerospace and defense stocks with someone who manages a fund of those names. Stay tuned. You're watching Market Catalysts. General Dynamics shares are higher today after topping second quarter earnings estimates boosted by higher jet deliveries. Joining me now, Tony Bancroft, Gabelli Funds Portfolio Manager for Aerospace and Defense. Great to see you, Tony. So let's start by sort of zeroing in on General Dynamics here and those jet deliveries. I think we were also waiting maybe for some guidance on the call from the company. Doesn't look like we necessarily got that yet, but I'm curious what you think here on GD.
Yeah, General Dynamics has a great business, and it's great to be back. They've got a wonderful business jet brand. Gulfstream it's a marquee brand. Everybody wants to fly the Gulfstream Super Heavy aircraft, and the consumer has changed. People that historically were flying business class realized during COVID that they potentially can afford flying, private aviation, and it's probably a structural change it's probably not going back anytime soon, and they're going to be a big beneficiary of it. You're going to see that, and then the defense business, again, they have a marquee defense business in the electric boat. The United States is pretty much the only world power that can park a nuclear submarine, right on your shoreline, and with ICBMs. Stacked. So, General Dynamics is going to be a big beneficiary of that business and the amount of growth that's going to be there from the defense budget.
There definitely seems to be an interesting dynamic within the aerospace and defense world currently in terms of sort of the big older defense contractor giants and some of the companies that are focusing on space or on new technologies. How are you thinking about that and where to deploy capital sort of based on that, Tony?
I think two things. I think one, they're going to partner. There's no question. I think the Andurils and the Palantirs and you name it, the defense tech will partner with the large primes and all the suppliers. I think it's a different industry than you'd say like maybe automotive, where it's very, very high volume. Even at let's say Lockheed makes 4,000 F-35s. Maybe say 10,000, right? The scale there is much lower scale than most industries. So you're still going to have, Honeywell making the ring laser gyros, and the components that go into the aircraft are going to be still made by these prime and their suppliers. And what they're going to do is they're going to partner with the technology and the software and the AI of these defense techs and sort of, work together and make a better product overall. But I think that's probably how it's going to play out over the long run.
That said, it's clearly yes, you've got stocks like Northrop Grumman that are trading near records, but in terms of sort of year to date or even 1 year performance, it is those newer players that have performed better in terms of their stock performance. Do you think that's going to continue to be the case?
Sure. Of course, they've grown quite a bit, and there's been, they've sort of had freakish growth in the defense tech space. And, you're probably going to see more of it. You're going to see more new defense tech startups coming. But I think in the long run, overall, it's going to probably be spread like peanut butter with the defense budget. You're seeing NATO spending looking to target 3.5%. That's a $500 billion increase if NATO were to spend at 3.5%. That's all of Europe's. That's all of NATO ex-US is budget. So essentially, we just double that budget. And the U.S., what grew 13% in the 26 budget of $1 trillion, and it's probably going to increase going forward as well. There's a lot to be done. People doubling production of weapon systems. You're hearing stuff from that yesterday with Lockheed and Raytheon. So I think in the long run, everyone's going to get a piece of this bigger pie, and and the defense techs are going to get a new piece of the pie, and they'll work together on that.
And Tony, you've been there at Gabelli, I believe, since 2009, and you have for people who are watching who don't know you, we talk to you frequently, but you have a history in the U.S. Marine Corps as an F-18 pilot as well. So you've been at this a while, you've been watching these companies for a while. It's been kind of a wild year in terms of how your fund has done, in terms of how these stocks have done. We haven't had a year like this in a little while. Are these growth stocks now? Like, has something sort of fundamentally changed as to how we think about them?
Yeah, I think we've been very fortunate. We've had a great year with GCAT, our aerospace and defense ETF, and the companies within that fund have benefited from commercial travel. You've just seen recent numbers come out of commercial travel, global travel still, hitting record highs, and the outlook is to continue. And on the defense side, the world's unsafe. When I was in the fleet, again, that's a long time ago. The world's even more unsafe than which I think everyone thought when we were back in the sort of it's called the Iraq War, or the global war on terrorism era. I thought that people thought the world wasn't going to get any more unsafe, and it has. So I think the reality is that there's going to have to be more defense spending. And yes, they definitely have become growthy, but there's still a lot of opportunities that we own in our fund, and we continue to like the space.
Yeah, and to your point, the fund is up about 36% year to date. Among other things, you got Palantir in there, which doesn't hurt. Howmet Aerospace, I think, is your largest holding. Last time I checked, that's up almost 70% year to date. There's one other name I want to mention that you touched on, and that's Lockheed, which of course just reported, and the shares have not been doing as well. It took a charge in one of its businesses. What do you think is the next move there for a Lockheed? Or do you think investors should get in here after the decline it has seen?
I think it's a buying opportunity. I think Lockheed, again, over the long run, people talking about drones and how drones are going to replace current legacy weapon systems. There's no question drones are coming, and they're going to be the future, and there's going to be a big part of the future. But for the foreseeable and investable future, you're going to need to do what the Israelis did in Iran and took out the S-400 sites. That was only going to be done by one aircraft, and that's the F-35. And Lockheed makes that, and they're going to probably be selling more F-35s in the next 5 years than they were probably having expected to. And it's because it's a fifth generation fighter, and the plane that I flew, the F-18, you wouldn't go near an S-400. When you were flying, you get shot down, and essentially every other aircraft in NATO's fleet would get shot down except for the F-35. So there's a reason why Lockheed is making these and why countries continue to want this with the explosion of AI and advanced drones. But to do complex missions where there's GPS denied environment, contested environment, and the need for real-time decision making, the F-35 is going to be the best show in town for the foreseeable future.
And as I mentioned, you know whereof you speak. Tony, it's great to see you as always. Thanks for joining us.
Thanks.
Coming up, we'll get a check on trading from the NASDAQ and some trending tickers, earnings, lots of earnings for you. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ, and let's get a quick check on the market action here. We are seeing gains across the screen. Gains are being led by the Dow, up around 0.5%, or roughly 220 points. The S&P 500 is up around 0.3%, and the NASDAQ is just up slightly here. So the NASDAQ unable to notch that back-to-back record close at yesterday's session. We did see the index close down lower, and you're looking at a 5-day chart right now. We saw that spike on Monday, but we just haven't been able to get back to some of those levels here, and we're continuing to wade through a lot of this reporting on the earnings front. Later today, we will be seeing results from both Tesla and Alphabet. That's surely going to shake up a lot of the tech sector. I also want to take a look at Treasury yields. We're seeing long-term yields edge slightly higher today. We are up around 4 basis points for the 10-year, trading right around that 4.4% level, which we have been waiting at that level over the past week. 30-year yields also up around 4 basis points. We are still firmly below 5%, which we were at those levels a few weeks ago, especially after President Trump ramped up his attacks on Federal Reserve Chair Jerome Powell. And this is coming as we have seen Japanese bond yields move higher on the heels of that trade deal between the U.S. and Japan that's lifting global yields across the board. But I also want to take a look at some individual names and zone in on Kohl's, KSS, because those shares are falling sharply today. We are down about 15% as the stock gives back a chunk of those gains that we saw yesterday. And this looks like a classic post-short squeeze move here. Remember that Kohl's rallied nearly 40% yesterday, and this was driven in part by short covering after short sellers lost over $260 million in a single session. But today, with no new catalyst really to keep that momentum going, we're seeing some of that profit taking along with short positions likely reloading. And here's why Kohl's is such a volatile name right now. And S3 Partners, they call it a battleground stock. So this means heavy positioning on both sides of the trade here. So nearly half the float for Kohl's is sold short. Meanwhile, institutional investors hold over $1 billion long, and then you have hedge funds that are split on both sides of the trade. So when the stock moves, it moves fast. It's very volatile. But the bigger picture here is that this is typically what we see in a bull market. You can look at names like ARK, Innovation ETF, Goldman's Non-Profitable Tech Index. Both are crushing the S&P 500 this year. And in a bull market, we tend to see some of that price action, even with unprofitable companies or with companies that don't have solid fundamentals. So yes, very memey and speculative on the surface, but strategists have told us that this isn't too surprising considering where we're at in the current cycle. And Kohl's just another example of some of that trading action in motion there. But keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We are watching GE Vernova, Thermo Fisher Scientific, and Enphase Energy. First up, shares of GE Vernova rising after the maker of gas turbines beat Wall Street expectations for the second quarter and also raised its full-year outlook. The company saw just over $9.1 billion in revenue in the second quarter. That was driven by a 44% increase in power orders, while wind and electrification orders fell in the period. GE Vernova expects tariffs and inflation to represent a headwind of between $300 and $400 million. It also, though, raised its expectations for full-year revenue, adjusted EBITDA margins, and free cash flow. Next up, Thermo Fisher Scientific also beating expectations and raising its profit estimates for the year, saying it sees robust demand from its pharmaceutical clients. Thermo Fisher makes pharmaceutical ingredients as well as scientific instruments, among other things. Chief Financial Officer Stephen Williamson saying, quote, the U.S.-China tariff situation has improved significantly from April. That's despite promises from the Trump administration that pharma sector-specific tariffs are potentially coming later this year. Williamson, by the way, he's going to retire as CFO in March of next year to be replaced by Vice President of Financial Operations, Jim Meyer. And finally, Enphase Energy shares sinking despite a second quarter earnings beat as the maker of solar energy equipment anticipates a hit from the U.S.-China trade war and the end of U.S. electric subsidies. Enphase anticipates lower than anticipated third quarter sales between $330 million and $370 million. Enphase shares have been battered in 2025. They've fallen by over 30% this year. Well, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we're taking a deep dive into AI. This as President Trump readies new executive orders on the industry. Stay tuned. You're watching Market Catalysts. President Trump is expected to lay out his artificial intelligence action plan at an event called Winning the AI Race, organized by U.S. AI and crypto czar David Sachs and hosted by the All In podcast, which he also hosts. Trump is also set to sign at least 3 executive orders as well, according to the Washington Post. One aimed at so-called woke AI, another on making it easier to build data centers, and in order to encourage exporting of U.S. tech. Joining me now on this is Sultan Meghji, the co-founder and CEO of Frontier Foundry and former Chief Innovation Officer of the Federal Deposit Insurance Corp. Good to see you, Sultan. Thanks for being with us.
Oh, thanks for having me.
So do you obviously there's been a lot of discussion about how to regulate AI, and there have been some changes in the so-called one big beautiful bill, right, that avoided the less regulatory path for it. Do you think that we're attacking the issue right now in the correct way?
Well, as you said, because of the changes to the big beautiful bill and the lack of a lot of legislative activities, the president is limited in what he can do. And that's where these executive orders come in. They're not really the force of law. They're more just statements of principle and where they're going to put their efforts within the existing legislative capabilities. So it's really all the president can do, and it does lever then on the private sector to then do things, build data centers, build energy production plants, build semiconductor manufacturing. And so it moves it from the government to the private sector.
What's your level of faith in the private sector doing that?
There's no one answer to that, right? Last week we saw this big event in Pennsylvania where they're talking about building new energy to fund data centers. We've basically increased the data center square footage here in the United States by about 80% in the last 20 years, but the electrical usage per square foot has gone up by about another 80% in the same amount of time. But our electrical generating capacity hasn't hit a 20% increase in the same amount of time. So we have this big gap in electricity that needs to be solved. And so, there are a lot of people getting their ducks in a row. And as we're seeing with the Stargate project from OpenAI and SoftBank, that's moving far more slowly than people expected. But then you see Elon Musk moving far faster than expected. So, some are moving faster, some are moving slower.
Well, you have sort of the infrastructure regulation of it all, and that there isn't sort of that plan, to your point. But then you also have the ethics of AI, right? And there, is it anything but the Wild West out there?
No, that's a great way to talk about it. The vast majority of the retail generative AI firms that people interact with on a daily basis are trained in unstructured ways on data that we don't necessarily have great visibility into. Sometimes it's trained on social media, sometimes it's trained on the Encyclopedia Britannica, if you're old enough to remember that. And so, you don't really understand how some of these older generative AI systems like OpenAI and Anthropic actually operate. The reality is we don't know how it's trained. And so it's not surprising at all that we see hallucinations. It's not surprising we see it have biases, whether it's to the left or to the right. And there are demonstrations of both out there.
And so what do you do about all of that, right, from a societal perspective?
Well, just like you have to be thoughtful about answering a phone for somebody asking for your credit card number, or when you go and search for something on the internet or read a news story, you have to know what you're looking at. You have to know how it's built. You have to be educated. A decade ago, nobody thought about multi-factor authentication. And now I'm sure the vast majority of people listening to my voice, at least have heard of that. And so you can't just throw all these technologies into a civilization and expect them to automatically work. The question is, do the regulatory activities or the attempts at regulatory activities that the Trump administration is doing actually make it clearer, or is it just trying to remove a certain category of AI from the market?
Do we have an answer to that question yet?
No, we don't. And I don't think we will for quite a while.
The other thing I want to ask you about is sort of the effect of AI on the workforce, which is something that it is being discussed more and more. But there too, there doesn't seem to be a regulatory framework. Does there, just like there needs to be sort of a grand energy plan, does there need to be a grand plan for what's going to happen to what will presumably be a lot of displaced workers?
Well, presumably, that's absolutely correct. I mean, and certainly in the technology realm, we're seeing organizations pull back on hiring because you can take what used to be 10 people's job and it's now 2 people's job. And that's the reality of what it is already. Going from the Biden administration, which was a very jobs-heavy economic policy, to the Trump administration, which is fundamentally a growth-oriented policy set for economics, you really don't have anything in play that protects the American workers except at the state level. California obviously has some stuff, New York has some stuff, but the reality is we are going to see significant disruption in the workforce, and we need to start planning for that. Now, because of generational shifts, as baby boomers continue to retire and they're replaced by Gen Xers, well, there are about half as many Gen Xers in the workforce as there were baby boomers at that age. So, there are less people in the workforce. You're going to see a pullback on it, but the impacts are going to be focused on jobs that fundamentally were created before these technologies could do them. So you see a lot of back office jobs, a lot of tech jobs. The first software development group I ever ran had over 100 different QA engineers, and now that same organization I think has 5. And so this is not a new thing. This has been going on for decades. The question just becomes, is it going to start moving outside of pure tech, and is it going to go to, people who work in factories and warehouses and things like that? And we're already seeing that. You see fully automated, Amazon warehouses where just the robots pack the boxes. We're going to see more and more of that, and we're going to continue this multi-decade evolution into a more services economy. And I think this is just going to accelerate that process.
Sultan, good to get your perspective on this. We'll keep talking about it. Thank you.
Thank you.
And speaking of continuing the conversation, let's do that now. Enterprise software company Pega reporting double-digit percentage gains in its annual contract value and cloud units in the second quarter, citing its AI strategy as a driver of the continued acceleration. Joining me now is Alan Trefler, Pega founder and CEO. Alan, I don't know if you heard the conversation we were just having. I'm sure you have many thoughts on those issues as well, but I do want to dig in first to the company's numbers here. You guys do a lot of sort of automation of business functions, enterprise functions. What for you is the sort of real demand driver right now on the part of your clients?
So we think that legacy transformation, which is looking at the systems you have and figuring out how you make them more effective, more efficient, how you consolidate them, how you move some to the cloud, is something that every enterprise is interested in because they're really looking to reduce technical debt. And at the same time, they're looking to incorporate AI into the way their businesses run to make their businesses more efficient. And we have a really terrific way to bring AI into the picture in a very predictable and a very safe way that doesn't fall victim to the sort of hallucinations you guys was just talking about, and is really generating a lot of excitement.
Well, Alan, I was looking at some of the commentary from your call, and you were talking about that your platform is model-based instead of hand-coded. Now, I have to admit, as someone who is not a coder, that went over my head, but how would you explain how your approach is different?
Yeah, so the way we think of life is very much vested in workflows, life cycles. So if you think about the things a business does, maybe they onboard a customer, or maybe they sell something, or maybe they open a relationship up with a new supplier. Each one of those is a workflow that has stages and steps and activities that may actually talk to different systems and talk to different people in different settings. We allow you to create a model, a visual way, for both the business people who actually are involved in it and the more technical people who would historically implement it, to be able to understand what the business is trying to do. And then what our software does is it executes that model. And now with AI, we can use AI in building that model to make it just smarter and more responsive and tremendously easier to do.
Well, and Alan, you heard us just talking about how the sort of employment trends could change as a result of AI. Are you able to do this kind of thing now with fewer workers, and are your clients able to as well?
Well, I think this will make our customers more efficient. And I think in the short term, it's more that things that they would not be able to do otherwise, they suddenly are able to do and get that efficiency for the rest of their business. So I think it's less about reducing the number of workers building these sorts of systems than suddenly making the whole business tremendously more productive and better able to engage that businesses, we're in the B2B space really, in the businesses' customers, so that they can provide better service, or they can do it much more effectively. And they can do it in a way that really leverages AI in that sort of predictable way, which is candidly very different than what we see our competitors doing.
And Alan, what does that mean in terms of growth for the company? You know, we mentioned annual contract value up 28% for cloud year over year. Do you expect this kind of momentum to continue for the foreseeable future?
Well, I think that growth was outstanding, and it reflects the interest in the products. The fact that annual contract value, that's the amount we have under contract with our customers, was going up, for example, 16% or 14%, is, to my mind, a real reflection of the interest in this new approach. And what I love is that the new approach to AI has fit perfectly into what we've done for the many, many years of our existence. We've been a public company for a long time. And being able to have a technology base that is suddenly broadly empowered by AI, I think puts us in a very advantaged spot.
And Alan, finally, I do want to zoom out and ask you about these new frameworks and regulations coming from Washington. President Trump is just out with what he's calling the America's AI Action Plan, and I won't expect you to have read all 28 pages, considering it just came out. Maybe we'll run it through ChatGPT or one of the other models and see what the summaries are. But what do you think needs to be the top priority from Washington in terms of regulating AI?
Well, what I like in terms of what Washington is doing is that they are really trying to get attention on making the AI better and more powerful and candidly better understood. We're in a position where we're not competing with those companies that would be building those foundation models. We use those models in novel ways. And what that lets us do is any advance in the way that the AI works, we're really able to take advantage of here. But what I love, and getting back to what your last guest was talking about a moment ago, and he talked about, once again, hallucinations. Because we primarily use the AI to design the solution, to really innovate and to be creative with the people who are saying, hey, how do we want our business to run? How do we want to serve our customers? And we iterate with those people around the creative process. But at runtime, when we're actually executing, we're actually doing things for the customer, we follow these workflows, these life cycles that are well defined. Because we have that combination, we're really not affected by some of the concerns and regulations that would exist that might limit the use of AI. Because everybody wants to control AI when people are like executing it. But when you're in a creative process, people are good with the AI being, I think, a little more creative. So I think that this is likely to be, very much more beneficial than hampering us. And anything that, once again, gets the attention on AI and how to make it more reliable and faster is from our point of view, a good thing.
Alan, thanks for joining us. Appreciate it.
Thank you very much, Julie.
Coming up, we've got our ETF report, where investors are putting their money amid record flows into the asset class. U.S. equity ETFs have seen $191 billion in inflows this year, representing about 60% of total ETF inflows overall. And international equities have had $81 billion in inflows. That's close to the total for all of 2024. As investors weigh continued trade uncertainty, where will the flows go next? Will we see continued trends? I want to bring in Julie Gunst, AllianceBernstein Global Head of ETF Strategy and Partnerships, for this week's ETF report brought to you by Invesco QQQ. Julie, thank you so much for being here.
Thanks for having me.
So I guess it's not a surprise that international has seen big flows. That's what we've been seeing and talking about when we look writ large. Where is some of that concentrated, and do you expect that to continue?
Yeah, I think if you look at, the international flows, it's really driven by performance year to date. So, U.S. equities, while a volatile first half of the year ended up, 6% for the S&P 500. If you look at the breakdown of international, European equities in U.S. dollar terms returned almost 25%. And so I think, ETF flows are, to some extent chasing those returns, but I think, also expected future returns. And so if you look at the returns in Europe, it's driven by industrials. So a lot of the defense companies, as Europe is increasing their defense spending, and also, infrastructure. European fiscal spending is expected to continue, and there are companies set up to benefit from that. We've also seen financials really lead. With the ECB cutting rate and that benefiting banks, and then utilities. Utilities are immune to tariffs, are immune to FX risk, and so have been performing well. On the flip side, in Europe, the underperformer is consumer discretionary, which is not surprising. Those are global companies impacted by U.S. consumer and potential tariff risk.
And outside of international, where are you seeing kind of interesting demand trends?
Yeah, we're really seeing demand for emerging market ETFs as well, especially on the active side. So AllianceBernstein is an active ETF issuer. There aren't that many true fundamental emerging market ETFs out there. And so we're seeing demand for that asset class as, fundamental investing really matters in emerging markets. And so continue to see growth there as well.
That makes sense. You guys only introduced your ETF business, 3 years ago?
Yep.
Yeah, it's just been amazing to watch the growth of the industry. How have you guys sort of managed to grab assets and market share? What do you feel like is your angle?
Sure, yeah, so we launched our first ETFs in September of 2022, so coming up on our 3-year mark and have about $8 billion in AUM. And we're really seeing growth. Our ETFs are driven by our research, our investment capabilities. And so, long-term investors, looking for active investment strategies. And we've also seen, areas of the market, our municipal bond brand is really strong. And so we have a suite of tax-aware ETFs. We've also have, a suite of buffered ETFs that have surpassed $1 billion. And so taking unique solutions or different types of investment outcomes and packaging them in ETFs for our clients.
Whether it comes to you guys or the industry writ large, the pace of record flows that we just continue to see year after year after year, anything that's going to slow that down, or is it just going to keep going? I
think it's going to continue to accelerate. So far year to date, we've seen over $600 billion in ETF flows in the US. Interestingly, active is almost 40% of that, yet still 10% of the AUM. And investors like the ETF vehicle. There's the transparency, the daily liquidity, the tax efficiency. And so as more money is put to work either from cash on the sidelines or mutual funds, single stock investments, ETFs are a really easy option and efficient options for people to get exposure to the marketplace.
I know you've also you mentioned in the break, you've been traveling internationally. Yep. What's the ETF industry and demand like outside of the US?
This year we also have seen, real growth in global ETFs. And so global regulators, I think, are, getting on board with that. This is a vehicle, of the future. This is a more modern option for investors. And, for example, I was just in Taiwan. AB is about to launch the first fixed income active ETF in Taiwan. Active ETFs were just allowed from a regulatory perspective earlier this year. And so different pockets of Asia, we're seeing similar trends. And in in Europe as well, ETFs continue to grow, both in the passive and the active space.
Interesting. Julie, thank you so much.
Thank you.
Appreciate it. Coming up in the next hour, we've got full market coverage ahead in the second hour of Market Catalyst, and we'll be digging into the meme stock rally. Coming up this hour on Market Catalyst. First up, the U.S. strikes a trade deal with Japan. We'll bring you the latest updates throughout the program. Plus, earnings from Hilton and Travel and Leisure offering the latest read on discretionary spending. We'll have details on that. And meme stock mania returns to Wall Street. We'll break down the latest companies to see a surge in activity and just how long those gains can last. All that and more coming up on Market Catalyst. Let's get a check on the markets, though, first here, because we are watching stocks kind of turning a little bit, well, they had been turning mixed in today's session, but for right now, we are seeing gains here for the three major averages. The Nasdaq's been the laggard throughout the day. Right now, it's up just about 0.1%. The S&P 500 up about 1/3 and the Dow Jones Industrial gaining about 0.5%, at least at the moment here. Moving on and taking a look at what's going on with stocks from a broader perspective. Of course, we've seen a bit of a hot streak. Stocks extending gains today after the S&P 500 breached 6,300 for the first time. It's notched 8 record highs over the past month. We're going for 12th of the year today. But that market euphoria has been paired with fragility under the surface, according to our next guest. Joining me now, Jeff Chang, co-founder and president of Vest. That firm specializes in target outcome investments and manages over $50 billion in assets across more than 250 products. Thanks for being here. Appreciate it.
Thanks for having me, Julie.
So we've been having this sort of discussion and debate about the under the surface signs. What are you seeing?
Yeah, I mean, if you look the stock market's at all-time highs, and a lot of it is, and if you think about overall risks in the market, right? Like you see anything from, are the AI mega cap stocks overvalued at current PE levels? And you think about, and a lot of consensus is a lot of the earnings growth associated with AI and the mega caps have already been priced in, right? Are we at that level that we're already there? And then on top of that, you have a lot of other risks that are there. Geopolitical risks, like if you think about, Israel, Iran, 20% of the oil comes through the Strait of Hormuz, which borders Iran. What are those impacts and how does that affect the overall economy? And then tariffs, right? I know a lot of people are largely, the market has anticipated that there are going to be some resolution, and we have seen, kind of like you explained today, the Japan deal that occurs. That gives a little bit of hope, but that's still fundamental risk in the market, and we're at all-time high. So this is where, we've seen a lot of our clients saying that, hey, where do we position our portfolio at all-time highs? And so a lot of times I say, when is the best time to buy protection or hedge yourself? Is it when the markets are all-time highs or when they've already dropped, let's say, a 15-20% pullback? It's like buying insurance. You don't buy flood insurance after the flood, right? And this is why we've seen an explosion and a really increase in interest in, like, let's say, buffer type products or hedge type products and investments because of the way the market is shaping up, because it is kind of the moment in which you actually want to hedge, because there is still a lot of fundamental risk within the market.
And so how then does this give them exposure, but let's try and limit the downside?
So in most buffer strategies, you get exposure to, let's say a broader index or any type of underlying, but in most cases it would be like, let's say something like S&P. And if it were to pull back, let's say 10-15%, these strategies would protect, let's say, the first 15% or first 10%. The reason that is that the most likely drawdowns in the overall broader markets are between 10 and 15% when you historically look at market drawdowns. Now, the way in exchange for that downside protection, you're giving up some upside. So let's say.
Well, that's what I was going to say. I mean, stocks, all of these obstacles that you mentioned.
Yeah.
They've been around now for a few months, and the stock market keeps making new records.
Yeah.
So you give up a little bit of that upside if you go, if you put, but you're not. I assume you would not recommend to somebody that they put everything into this kind of a vehicle.
Yeah, absolutely not. I think what's key here is the ability for an investor to diversify their risk management. Because traditionally, when you think about it, you have your traditional 60-40 portfolio, right, where the thought process is, hey, you know what, put some of my wealth in stocks and bonds. But here's the challenge right now. Unless you were managing money 40 years ago, you were not managing money during times of inflation. And what we saw in 2022 is as interest rates go up, both stocks and bonds fell in 2022, right? You could have mixed your stocks and bonds any way you wanted in 2022, you were down. This caught a lot of people by surprise. So the question then becomes is, what in your portfolio will save you if inflation rears its head again? And if you think about what is the risk of inflation, we're already starting to see some of the trickle effects of tariffs into, the inflation numbers. And then also, what about wage growth? That's been really pushing upwards into inflation numbers. And then, like I said, geopolitical risk, right? If 20% of oil is coming through the Strait of Hormuz, if oil prices and then oil goes to $90 a barrel, you're going to see headline numbers like headline CPI really spike. Then the Fed has to act. Right. Then the market, while they baked in, let's say, a 75 basis point cut later this year, then that starts to come into question. That could really affect equity markets, not only equities, but also bonds as well. And this is why we think hedging, which has the great thing about hedging is it's perfectly negatively correlated to whatever you're hedging, as opposed to relying on the negative correlation between stocks and bonds, where traditionally, when stocks go down, you have this hope that bonds go up, right? That starts to break down in certain environments, especially when you start to have inflation.
Yes. On the flip side, those things might not happen. Right? In other words, it looks less likely now than it did a month ago that the Strait of Hormuz is going to be interrupted. And, even if you see inflation, and then what role does gold play in a portfolio also if you're trying to hedge against inflation? Yeah,
and I would say not just gold, but also like things such as like Bitcoin and so on and so forth are all really interesting things. And it's not to say it will happen. It's saying that if it does, what do you have in place to defend against that? And that's what's great about, let's say, just even taking buffer strategies as an example, you're still participating in the market. Right? That's the thing is that like getting people to stay invested is one of the most important things. And we find that, downside hedging can be a really big benefit to, everyday investors as far as keeping them invested. Especially with these types of risks on the horizon. And we're at all-time highs.
Yes, we are indeed. Jeff, thanks so much for coming in.
Thank you for having me.
Appreciate it.
Great.
Coming up, travel stocks reporting earnings today. What that tells us about the health of the consumer. We'll be right back. Shares of Travel and Leisure Co. on the rise this morning after it reported second quarter earnings in line with Wall Street's expectations, reaffirmed its full year outlook as well. The company brought in just over $1 billion in total revenue in the quarter, with its vacation ownership segment showing year-over-year growth of about 5.7%. Joining me now is Mike Brown, Travel and Leisure CEO and President. Mike, it's good to see you.
It's great to be back with you. Thanks for having me, Julie.
So I think everybody's sort of trying to get their arms around the travel environment right now, right? We hear from airlines on the one hand, sending signals that sort of the premium traveler seems to be holding up, sort of mixed signals from your peers in the hotel business. What are you seeing in terms of the timeshare business? How would you characterize it?
Extremely resilient, extremely consistent. And although we just reported Q2 earnings, we're deep into the summer travel season, 3 weeks into July or 3 weeks into quarter three, and nothing seems to be changing. The uncertainty that's out there today in the macro environment, I think caused a lot of people to pause early in Q2 and say, where's travel going? Leisure travel, as we learned coming out of the pandemic, is something that people will not give up until they absolutely have to. And what we're seeing is some minor modifications on how people are traveling, but demand equally strong this year as we saw this time last year.
And Mike, how much of it is new timeshare owners versus that sort of steady revenue that you get from folks who already have them and sort of revenue from them swapping, trading up, for example?
Well, it's a great question, and it's a real testament to our brand. About a third of our transactions are to new owners, and the remainder is owners buying more. And when you think about what that says, is that when 2/3 of your owners are buying more time every year, it says they're satisfied with what they own. Interesting statistic is our owners take about 4 to 5 on average vacations with us on an annual basis, which represents over 50% of their vacation time. When you first buy, you're buying maybe half a week or a week of your time and testing the waters as to, is this the type of product I enjoy? But the consistency, the value that's created, and the flexibility means that people come back and they buy more. So yeah, we've seen an incredible loyalty, incredible level of satisfaction. And in fact, about 98% of our fully paid off owners stay with us on an annual basis. It's an incredible retention rate.
And we were just showing some of the demographic data too on that screen, that 65% of your new owners aren't boomers, right? They're younger, Gen X,
That's right.
Millennial, Gen Z. Presumably when they sort of trade up, when they buy more time, maybe that's because they're also entering retirement, and that's one of the ways they want to do it. So does that give you confidence, though, that there is that pipeline for the next generation when they retire and can spend more time on the road and traveling?
You've gotten it exactly right. We see a different purchase reason depending on your age. Across the industry, the average new owner purchase is 38 years old, which is right in the heart of the millennial generation. Those people are buying really to enjoy amenities and consistency in a brand they trust, whether it's us or another one of the brands in the space. That's their motivation usually for buying. As you use the product and realize you have a lot more time, or you move into the boomer years or the late Gen X years, you start to have grandchildren and you want to vacation with them, so you buy either more time or more space so that you can have multi-generational travel coming together. And our product allows for the flexibility from a family that's recently formed that's looking to vacation in some quality accommodations. That's your younger first-time buyer, and then as people buy more, they're buying for different reasons, really to spend time with their loved ones across generations.
Any hits that you're seeing anywhere? Any changes that give you any reason for concern?
I won't say reason for concern, but I'll give you a few minor points that we've noticed. Length of stay continues to move up. We think that's a real trend that's here to stay, which is work from anywhere. The idea of having a mobile office and working from a resort kitchen table on a Thursday night or a Friday to get your weekend started I think it's here to stay. Cross-border travel, we've definitely seen Canadian travel decline this year. We've seen it noticeably fall off in the US, but for us, who has plenty of resorts in Canada, they're still vacationing, but they're doing it within the Canadian borders. I think lastly is we've been watching very closely the number of drive-to arrivals to our resorts, because that tends to indicate for us that, hey, I'm a little more hesitant to outlay a lot of money for whatever reason, inflation, uncertainty, whatever the case may be. In our case, we're not seeing an increase in drive-to, which means from our standpoint, we have 109 days visibility into our booking window, and we're not seeing a drive-to, fly-to trend change, which just speaks to us, and our conclusion is the consumer's resilient, they're still vacationing, and they're not getting distracted by macroeconomic news to forego their leisure travel to 2026. They're getting on vacation this year, and they're doing it in very similar ways than they've done it in prior years.
Interesting. Mike, always great to get your perspective. Thank you.
Thank you, Julie.
Let's continue this travel conversation because Hilton is posting higher profit and revenue in the second quarter. It also raised its earnings outlook for the year. Still, the hotel operator's revenue per available room fell 0.5% due to occupancy declines. Joining me now, Chad Bynan, Macquarie Group Gaming, Lodging, and Theaters analyst. It's good to see you. So as we are looking at these numbers, it looks like the company did trim its net income forecast a little bit, although some of its metrics look good. What's your read on the quarter?
Yeah, sure, Julie. Thanks for having me. Second quarter came in slightly better than expected. I think some of that was timing around termination fees and just kind of how the holidays impacted some leisure versus business travel. Their third quarter guidance came in a little below expectations and where consensus was. So positive on Q2, negative on Q3. And then for the year, they kind of stood pat in terms of how they were thinking about the year. I would say the tone was slightly more positive, particularly calling for more of a business travel recovery in the back half of the year. And then as it relates to the leisure traveler, as your last guest talked about, I think things are fine. I think consumers continue to prioritize experiences, and we saw that this summer. FX could be a slight positive because going to Europe or leaving the country is a little bit more expensive this year. So as we've seen, people might stay closer to home and vacation with drive-to or shorter haul flights.
Well, and I was talking earlier, too, about what we heard from the airlines, which seemed to be that sort of full-service premium customers were holding up better. Are we seeing that play out in the lodging world as well?
Absolutely. When we analyze the chain scale trends, revenue and occupancy in the United States, those higher-end full-service brands continue to outperform. I think that's been the case for almost a year now. So it certainly calls the question, what's going on with that lower end economy, chain scale focused brand or portfolio. So we continue to like those that lean a little bit more upscale, as we know the consumer is kind of fickle here. People are enjoying experiences, but the last 2 or 3 years, I think people extended their budgets in every age bracket. So the people in that luxurious level were spending a little bit more, but also people in kind of the lower chain scales were spending more. So that's kind of what we're keeping an eye on, and our ratings kind of reflect a view towards some of the higher end brands.
Well, I was going to ask, I know you got a neutral rating, right, on Hilton. Is that why? Because they, just because of their sort of hotel mix and who their audience is?
Yeah, I'd say fundamentally, I think net unit growth has probably been better than expected during the past couple of years. The RevPAR, which is a key focus for analysts, has been roughly in line. I think one of the reasons why lodging stocks outperformed in 23 and 24 compared to the S&P, it's really the business model, right? The franchisor business model continues to receive praise from investors, and it was about a 10% outperformance for the group in 23 and 24. So we're looking at these stocks trading, around 30 times earnings, which is where we see high growth stocks in the market trading. So they're clearly in that category. And that's kind of been why we've maintained our neutral rating. It's certainly above historical trading levels, and we are waiting for a little bit of a broader recovery to become more constructive on Hilton.
Let's talk about Hyatt, which I believe is still your top pick in the industry. We have to wait for their earnings a little bit. They report they're due August 7th. Similarly, is this a combination of sort of valuation, but also where they skew?
Yeah, so Hyatt skews definitely more towards the luxury lifestyle consumer versus Hilton or Marriott. That's really bigger and slightly broader. I think Hyatt is kind of focused on that. So bigger isn't better. Better is better is kind of their mantra. They've also made some acquisitions in the past couple of years. They acquired a company, Playa Resorts, down in the Caribbean markets. They get into the all-inclusive markets, and they've acquired some other boutique-y types of portfolios around the globe. We like them because of where valuation is. It's a asset-like transformation, right? They're selling their owned assets that they've owned for decades. Hilton and Marriott have already done this. So I think as they sell these assets, and we're seeing prices for luxury goods, whether it's hotels or sports teams, right? Hit record prices. So we think there's a good market for Hyatt to hit the bid there. And then as they bring in the fees, we think that multiple will re-rate closer to these franchisor multiples that we're seeing for some of the other hotel corporations.
And then, Chad, just quickly, as we look to the second half of the year, you talked a little bit about some of the trends that we're hearing about. Obviously, on the sort of macroeconomic front, there are a lot of conflicting signals. So what is all of that going to spell for consumer spending, not just on lodging, but on all of the stuff that you cover?
every month is different than the prior month, right? I think in every quarter we're seeing two good and one neutral in terms of data points. So it has been difficult to kind of think about where growth will be in the back half of the year, and then more importantly in 26 and in 27. Across our coverage, particularly in the gaming space, we're still seeing names that are trading at historical low valuation levels. And as we've seen with private equity companies, they have a lot of money that they're trying to deploy. So we're focused on quality consumer driven companies with lower valuations, and particularly those that skew more towards the higher end. But yeah, I think the wealth effect from the stock market, the property market, what we've seen in the past couple of years, there was a lot of turmoil around the election and then around Liberation Day. But there's a lot of wealth that's been created. Employment still looks good, gas prices are low, and the wealth creators have been high. So we expect people to spend on that discretionary tail, which is a little bit more cyclical than other consumer areas.
Chad, good to see you. Thanks.
Thanks, Julie.
Coming up, we'll be checking in on the NASDAQ and some movers, including Lucid. You're watching Market Catalysts.
Welcome back to Yahoo Finance Live. I'm Ali Canal, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. And we're still seeing those gains holding up across the board here. The Dow trading in the green, up around 220 points or 0.5%. The S&P 500 up about 0.3%. Now, if these gains hold, this would be yet another record close for the benchmark index. And then the NASDAQ Composite, the biggest laggard of the three, but still holding on to some of those gains. And if we take a look under the hood of the NASDAQ 100, you're going to see some of those magnificent seven players: Microsoft, Apple, Amazon, Alphabet, trading in the red here. We do have Nvidia up about 1.5%, trading just under 170 bucks a coin. This is one stock that has just been on an absolute tear, hovering around that $4 trillion valuation. Broadcom, not part of the Magnificent Seven, but still a big story when we look at the AI boom at large, is up around 20% year to date and around 1% today. Tesla, this is one name that we're going to be watching very closely today. Those results due after the bell. Year to date, we are down around 17%. But since some of the lows that we saw when Elon Musk and President Trump had their falling out, we are up from that moment. So if we take a look at maybe a 3-month chart, you're going to see some of that choppiness. 3 months, though, up around 33%. So this is one name that's usually pretty volatile after these results, so we'll be tracking those very closely. Alphabet is another company that we will be hearing from after the close, so the start of a lot of these Magnificent Seven players. But keep it right here on Yahoo Finance. We'll be tracking all of the market moves throughout the session.
Time for some of today's trending tickers. We're watching Goldman Sachs and BNY Mellon, Lucid, and Roblox. First up, Goldman Sachs and BNY Mellon joining forces to launch tokenized money market funds. BNY clients will be able to invest in these funds, and the ownership will be recorded on Goldman's blockchain platform. Besides BNY and Goldman, BlackRock, Federated Hermes, and Fidelity will also participate in that launch. Now, Ali, still with me. Ali, the sort of tokenization of everything that maybe is coming, interesting trend, especially coming to the sort of normally very staid world of money market funds.
Exactly. This is definitely a shift that we've been seeing across the financial space here. And the goal is to enable faster 24/7 trading, make money market funds usable as collateral or in digital payment systems. It ties into the broader push that we've been seeing in this post-Genius Act era towards more regulated financial tools with like stable coins, programmable finance. Goldman's saying this would add real utility to a $7 trillion market that hasn't evolved much until this moment. And we were talking about the modernization, I guess you could say, of financial markets at large. And now that tokenization, stable coins, these are words that are more in the vernacular of these businesses, along with the trading strategies of both retail investors and institutional investors. It's a big moment and a big shift that strategists have been telling us has been a little underappreciated at this point, that this is going to be the future when we look at some of these trading possibilities here. So this partnership only illustrating that.
Yeah, we'll see, I guess, what the demand is for this. Next up, Lucid is partnering with several North American critical mineral producers to establish a stable supply of certain minerals that are essential for making EV batteries. The focus on domestic production will help reduce reliance on international sources. The share's up just a little bit here, but obviously this is a bigger story, right? And part of the bigger trend on the part of the Trump administration to beef up the homegrown minerals industry. The problem is there just aren't as many choices, right? Most of the critical minerals that are used in this country in manufacturing are indeed imported. So there are only so many sources domestically for this stuff.
Right, and like you were saying, a big push from the Trump administration to onshore a lot of that production, really improve that EV supply chain. The group is called MINAC, I believe that's how you pronounce it, Minerals for National Automotive Competitiveness. Partners include Alaska Energy Metals, Graphite One. So they want to U.S. source those minerals like lithium and graphite, which are key for a lot of the production of these EV vehicles. So really try and sync the mining sector with the auto sector. They are hosting a roundtable today in D.C. with lawmakers from Alaska and Arizona. We'll see what could potentially come out of that. But like you were just saying, Julie, this feeds into that larger push to bring some of that production here domestically. The issue is, though, the supply. Do we have enough to really fuel all of that demand there and compete in what has become a very competitive global marketplace? So still a lot of questions here, but this is a first step that is illustrating this larger push to bring some of that production back home.
Right. And finally, Jefferies is initiating coverage on Mike Novogratz's Galaxy Digital with a buy rating and a $35 price target. That would imply about 20% upside. The firm is citing a benefit from clearer crypto regulations and demand for AI data centers. Those shares moving up by about 7% here. It's been interesting, this trend that we've seen among some of the crypto mining companies to sort of lease out some of their space for AI, right? And that seems to have been working well for some of them.
Yeah, and that's totally right. Galaxy did have those Bitcoin mining sites that have been converted into AI data centers. Their Helios facility in Texas now powers CoreWeave's AI operations. That's something that Jefferies described as a, quote, transformational lease. The firm is also benefiting from the Genius Act, which we were just talking about, this regulatory environment for stable coins. And also an important note here when we talk about the AI boom, Jefferies saying that 2/3 of Galaxy's value now comes from data centers, not just crypto. So this company has totally evolved its operations, evolved to adapt in this new AI-driven world. And if you take a look at shares, year to date, we are up around 65%. So investors clearly liking that shift as well.
Yeah, I mean, doesn't hurt the Bitcoin is up where it is either for that company, Ali. Thank you. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up next, we're bringing down sector flows in the latest episode of Stocks in Translation. Keep it here.
The industrial sector is up over 30% off of those April 8th lows, while healthcare has barely budged. On today's episode of Stocks in Translation, we are taking a look at cyclicals versus defensive sectors. And first, let's define cyclical sectors. It is those sectors or industries whose sales and profits swell in economic expansions and shrink in recessions, making their stocks swing more than the broader market. And a few examples here. We have consumer discretionary. That's the stuff that you want to buy as opposed to the stuff that you have to buy. We have industrials, materials, financials, so think the big banks there, tech, and I'll come back to that in a second, communication services, which is kind of an odd category, and real estate. So let's get back to tech there. Some have argued that tech should be in a class of its own, and also with the push towards recurring revenues, a lot of its profits and sales are a lot more steady than they used to be. But especially at the upper end of the scale where you have the mega caps, a lot of those have become quasi-defensive in nature. So it's kind of, there's some gray area there. And then communication services, well, that houses houses, Alphabet, Meta, Verizon, Netflix, and sometimes some of those telecommunication stocks, those are defensive as well. So let's get into the defensive sector definition. These are industries whose demand stays steady in booms or busts so that earnings and share prices move less with the economy. So they're a little bit more stable there. So instead of consumer discretionary, we have consumer staples. That's the stuff that you need to buy. Healthcare, utilities, and energy. Energy is an interesting one because it's almost counter-cyclical, but it is defensive in nature. It tends to outperform when the Fed is doing certain things in the business cycle beyond the scope of this conversation. But for here, we're going to classify it as defensive. This leads to the next chart, which is really jaw-dropping. This comes from Todd Sohn over at Strategas ETF Research. I call him the ETF whisperer. And this shows you all the defensive sectors combined versus two stocks, NVIDIA plus Microsoft, how much they are taking up in the S&P 500. So let's do the defensive. I'm going to trace these sectors out first. They started at 40% in 1990, and then since the early 2000s, they have just drifted down. They are only at 20% today. Then you take the Microsoft and NVIDIA combo, and NVIDIA only came to market in the late 1990s, and it was kind of steady down here, but really took off in the teens in the area of the FANGs and all that, and we have seen that climb to 15%. So two stocks are now approaching the entire value of all the defensive sectors, and it just shows you how much investors have come to really rely on those cyclical names. Now, I'm going to show you a chart since the April 8th lows. This shows you ETF flows into cyclicals versus defensives. And in white here, we have cyclicals, and then in green, it's defensives. And what I want to show you first, both of these went down. Now, the April 8th low was a low, so stock prices were heading up from there, but ETF buyers across the spectrum did not buy that. And then in terms of the defensive, we saw a little bit of a bounce, but then they resumed their downward trend. And we can see that they have shown or have not gotten really a lot of love since those April 8th lows. Now you contrast that with consumer cyclicals, and they found a bottom into the end of April, and they have now climbed all the way up here, sitting at about $2 billion versus about $4 or $5 billion of outflows for those defensives. So a pretty stark contrast that we're seeing there. Now I want to show you the S&P 500 in white here versus something I call that's called relative strength. It is consumer discretionary divided by consumer staples. So XLY I'm using as a proxy for consumer discretionary, and then XLP is a proxy for consumer staples. You can see the S&P in white there, but I'm going to trace out what happened in this ratio of XLY to XLP, and you can see it got really interesting as of late. Let me just show you the area before the pandemic. We had that ratio consolidating. Meanwhile, the S&P 500 was hitting record highs, but then precipitous drop, and then we saw a huge rebound in cyclicals. And then after the bear market of 2022 right here, we got a rebound to massively new highs in the S&P 500, but the ratio XLY to XLP was only able to get to that prior peak right here. And now I'm going to clear the annotations and show you that even though the S&P 500 has reached record highs recently, XLY to XLP has kind of stayed there below its recent highs. And I think this kind of ties into the argument that we have seen narrow breadth in this S&P 500 rally, which is not a sell sign, but it is a yellow warning flag going forward. So, wrapping it up here, tune into Stocks in Translation podcast for more jargon-busting deep dives, new episodes. You can find them on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. More market catalysts after this.
Meme stock mania is back in the market as retail investors pile into little-loved names like Krispy Kreme and GoPro. Meanwhile, the meme darlings of yesteryear, literally Open Door and Kohl's yesterday, are falling. Joining me now in this ever-evolving story is Tom Sosnoff of Tasty Live, founder and CEO. Tom, it's good to see you here. I mean, this kind of thing keeps sort of rearing its head periodically, right? And a lot of it has to do not necessarily with fundamentals for these stocks, but maybe more for high short interest where traders see an opportunity to sort of push a squeeze through. What do you make of it, and does it tell us anything about bigger picture investor psychology right now?
Well, I think it's probably, it may speak to a couple of distant red flags, but I think for the most part, I don't actually like the argument that it's a short squeeze per se, because most of these stocks, especially when you're talking about like GoPro at a buck and something, and you're talking about Open, which was $1, $2 stock at the time. Most people aren't short, $1 and $2 stocks. I mean, that would be pretty rare to have a short squeeze, on a $1 stock. I mean, Kohl's might have been a little bit different, but when you start to think about, really cheap stocks, most people cover their shorts by that time. I think it's just there's a lot of speculative money sitting on the sidelines, and it's kind of like fun. It's more of a game.
Well, and one of the things that sort of speaks to that, maybe our head of news, Miles Udland, has this vibes-related theory about the meme stocks, is that there's sort of a millennial nostalgia quality to this, right? When you talk about a Kohl's or a GoPro, for example, that maybe is feeding into this a little bit.
I think that's some of it. And this morning, we were having a discussion on Tasty this morning about it. We were talking, and I was saying, you know what? This is also the time of year, I know it's going to sound crazy, but this is also the time of year where there's no real sports to bet on, because it's really just baseball. And we're kind of in between, all the other sports. Football season hasn't started yet. So, what better place to gamble than a zero commission, zero fees, in and out of all these little penny stocks for basically no money. I think it's just a lot of, again, it's a little bit of speculative fever, and it's not from a brokerage perspective, we like it, not because of the volumes, because they don't really mean anything. There's no money in this. It's more of just getting people engaged. And if it brings young people into the marketplace, it's not necessarily a bad thing. I just think it's hard to make money.
Yeah, I mean, I guess maybe somebody is making money in this stuff, right? I mean, but it's also interesting to me because that, Tom, is a little bit of a shift as well. Like in the beginning of the meme stock boom, there was a lot of sort of hand-wringing, like, these people don't know what they're getting themselves into, and they could really lose their shirts. And I feel like we've sort of evolved from that, right? Like, I think everybody knows you could lose some money. Like, it is a possibility. Or do you? Do you think that that's not still well understood?
No, I think there was a couple of factors, like a perfect storm. If you're talking about like 2020 and you're talking about GameStop, and there was a bunch of factors, and there was a lot of professionals that got involved, on the short side of GameStop, from hedge funds to market makers. And that was a very different animal back then. Now it's a little bit different. This is very similar. I mean, this is almost pure retail. And this is very similar to, just kind of like a meme crypto coin or something like that. And it's kind of just like it's a pie in the sky. It's just a cheap shot, I think, the way people are looking at it. And I wouldn't read that much into it, except when this stuff happens, the markets are usually getting a little frothy. Like a lot of the big names are kind of off the table because they've had such incredible runs and they're so expensive.
Right. I mean, it's funny also that you're not seeing a GameStop or an AMC or whatever really as much participating in this current situation. If people are going to play this stuff, if they are going to, for lack of sports gambling, if they're going to do this kind of thing, I mean, what advice would you give them as an experienced investor? If they're going to do it, what's the best way to do it or the best approach to take?
Well, I'm an experienced player because I've been around the block for a couple of four decades. But when it comes to this kind of stuff, like penny stock stuff, I'm just like everybody else. I mean, I don't have any edge. My preference, I'm mostly a derivatives trader, so I trade mostly options and futures. But when it does come to penny stocks and stuff like that, and this kind of, meme stock stuff, I actually like trading the stock more than I like trading the options. I think the option markets on a relative basis are a little wide, just given how cheap the stock are, and there's a little less edge. I think these stocks are a better pure play. And like I said, they're transaction free at virtually every firm. So, and the bid-ask spread's only like a penny wide. So I think if you're going to play the game and you want to take a small shot, you just want to, throw something out there and see what happens, I would do it using the underlying stock.
Do you think that any of these companies are in a position to capitalize on this? I mean, I think that AMC is probably the best example of that. I, off the top of my head, can't think of any other companies that have really done a good job of that. Do you think, though, there's opportunity here?
I mean, I think that I think that GameStop, when you look back, when history kind of talks about this, all this stuff, I think GameStop is the one that was able to kind of float some stock and raise some capital and change their model and all this kind of stuff. So I think GameStop got lucky. I think these other companies, it really doesn't have much impact. It's if any one of these companies like Kohl's or any one of these other companies were to try to go out and float either convertible debt right now or stock or anything like that on any kind of an uptick, they would just slam the stock. So I don't think it changes the company. It brings some of them back into play. I mean, it's great PR if you've never heard of Open Door before, if you forgot what GoPro was or something like that. I mean, the PR part of just getting your name out there, that's not bad for these companies. But I don't really think that this is not a transformational or life-changing moment for any of them.
Right. Tom, fun to talk to you about this. Thanks for joining us.
Thanks for having me.
And that's it for Market Catalysts. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.